Focus. Ideate. Innovate. Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to the Mutual Fund Day Family Financial Plan series. As always, we're here to help you understand the nuts and bolts of financial planning. How do we do that? By featuring case studies from different parts of India of investors whose lives have changed thanks to the right financial planning. Today's episode, we are at Hyderabad and we are here to understand the investment planning journey of Rahul Chitti Boina. So let's start with a brief look at his financial profile.
Long-term and strategic investments can lead to a very stable and happy life. No one understands this better than Rahul Chitti Boina. A merchant navy captain by profession, Rahul has been investing his savings in a premeditated way since the days he was just a cadet.
My name is Captain Rahul Chitti Boina. I'm a sailing captain in Merchant Navy. So I've been sailing for almost like last 20 years. I started in 97. I've been with the same company. It's a US-based oil major company. I've risen through the ranks and from a cadet to captain and basically, sailing since last 7 years as a captain. Started investing when I was a junior officer. This was early 2000s, more with advice from my parents. I started keeping away a certain percentage of my monthly salary, be it, FDs or SIPs towards like buying a plot. So those were the initial things which I done along with the LIC policies. Yeah, that's when I started looking at investing.
When not transporting oil in giant tanker ships for an American oil company, Rahul lives in Hyderabad with his wife Preeta, who is an MBA professional from ICFAI Hyderabad, and their daughter Nitya, who studies in grade 2 at school.
My name is Preeta and I'm a housewife. I did my graduation from Delhi, Miranda House, and I've done my MBA from Hyderabad. I used to work in G Money in Raipur. My husband, he's a sailing captain. He's in Merchant Navy. We have a daughter who is 7 years old. We started investing in mutual fund 2-3 years back. Before that, we were investing in more traditional way, like FDs in the bank and doing the LICs. But then we wanted something which is more structured, and we wanted to invest in a more systematic way to achieve our long-term as well as the short-term goals. Our daughter's higher education is our primary goal. And the second thing is I would like my husband to take an early retirement also, so that he can spend more time with us.
In his decade-and-a-half-long professional life, Rahul has amassed a decent folio of investments and now needs advice to achieve financial independence.
I started taking advice from my financial advisor from the MNC bank, and those were either for mutual funds or towards the ULIPs, ULIP plans, having some coverage for insurance and equity. But then I had mixed results with this. I was not entirely happy with the way lock-in periods was and various other aspects, and not entirely happy. So then finally I met my financial advisor, the present financial advisor, and this was about 3 years ago. Then we sort of sat down. This was a more structured approach. We discussed goals, long-term, short-term goals. Then we decided how we're going to achieve these goals, in what sort of time frame. Inflation was taken into account. Since then, it's been with this financial advisor Subir, who's helped me achieve these goals, structured and more disciplined into the whole investing part, which has been good.
In today's episode, we will help Rahul to get the best advice to achieve financial freedom quicker than conventional professions and set up a corpus for a long-term financial stability of his family.
right, now that we have a broad understanding of Rahul's investment planning journey, let's take a short break. On the other side of this break, we'll get a detailed analysis of Rahul's balance sheet. And to help us do that, we'll be joined by Subhir Jha, an independent financial planner. Stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. Now, in the previous segment, we got a broad understanding of Rahul's investment journey, our featured investor. In this segment, we get a detailed analysis of his balance sheet. And to help us do that, we're joined by Subhir Jha, an independent financial analyst. Gentlemen, thank you so much for joining us. Rahul, let's start with you. You started working in Merchant Navy 97. Your investment journey started in 2000, pretty quick. So what was the motivation to start your investment journey so early?
So, as in any traditional sort of family, the earliest financial advisors for me were my parents, actually. And that was the major sort of the boost that, you have to start investing as soon as you start earning, So that was probably the initial motivation, And then I'd started at 2000, but again, it's been various products, all over, like, let's say, real estate to mutual funds to LIC policies, and but it was not structured initially, So as the years grew by, and I was banking with a multinational company, multinational bank. Then we had a financial advisor from the bank itself suggesting some of these various tools and products.
So you got for the idea of a structure from there on, and then you built on that structure.
Yes, I would agree. Yeah, slowly. It took time. Eventually, there were no goals, as in early 2000s. But then those goals, with education and with marriage and with kids, of course, those goals became more and more clearer. And then we came to a structured, sort of a balanced outlook on what we must be doing, and then proper discipline in how we go about doing those things.
All right. So fast forward now, what's your portfolio allocation look like?
So I would say something like 60% is real estate, actually. So traditionally, from an Andhra family, we were you always looked at real estate as the primary financial, the asset class. But then since I started this mutual fund journey, I think right now, for the rest of the 40% part, I would say 20% is in equity and 20% is in debt funds.
Okay.
That would include a part of my company's retirement fund as well. That is included in that debt fund.
All right. Well. So it's interesting when the investor comes and says, I've got 60% in real estate and 20% in equity and 20% in debt. So what's the game plan here? As in, do you think he should stick with his current portfolio allocation, or is there scope now, you see, of a gradual sort of a removal of some of the portion of real estate and then putting it into more liquid instruments?
Gautam, one of the conversations that we have been continuously having, me and Rahul, is about realignment of some of these assets. And I'm sure Rahul also appreciates that. And both of us are working towards having a more balanced asset allocation in place. And while every asset has a role to play, if any particular asset is having a disproportionate amount of allocation, it can definitely, put back the resource, the returns that you can generate from these investments. So therefore, that is definitely one of the focus points. And over the next medium to long term, we are looking at rebalancing the portfolio and tilting it more towards financial assets.
What's the starting point for the benefit of viewers, a lot of whom might have a substantial chunk of their investments logged in real estate, but who might be thinking of investing it in more liquid instruments? Where do they start? What's your view on that?
So we are very clear on this. The approach is, first step is to understand where you are. Many a times people are not aware where they are. So that's the first starting point. Once you do that, we are big supporters of goal-based investment. So we try and sit with them and identify your goals. So once you do that, then you create investment plans which can help you achieve those goals. And within that plan, you have to see which asset or which product can best help you achieve that. And there is no denying the fact that a more liquid, easy to manage product is mutual fund. and that's how they can go ahead and achieving some of these long-term goals.
Subir, let me focus on the equity and debt part of the picture here for Rahul. Within equity, what kind of funds is he invested in? What's the exposure like?
So when we did the risk profiling for Rahul actually, and considering his age and his income profile, he can take slightly higher risk compared to a normal investor. Given that we have around close to 50 to 60% in large caps, remaining 40% is more or less divided between mid and small caps.
All right.
And now gradually we are also having 5 to 7% of a thematic fund as well that way. So that's the rough allocation between equity funds.
And when it comes to debt funds, what's the breakup?
So what we have done is, if I keep aside the emergency corpus that we have created and I look at debt as a long-term allocation, we have into medium and long-term accrual funds allocation as such, which are with a horizon of 3 to 5 years.
Okay. Now, Rahul, when you had the conversation with Subir about your investment, what was your expectation in terms of returns for your equity and debt funds? What figures did you have in mind?
So, higher the better, but no, I'm just kidding. But I think for equity, we were looking at anything like 12% was a conservative figure. That was beating the bank FDs, and at the same time, the capital, I wanted some liquidity as well. So that was 12% for equity and 8 to 9% for debt. That was my expectation, and that's what I think we've been aligned, and that's what we discussed.
So has his portfolio matched his expectations? How would you characterize its
performance? First of all, thanks to Rahul for setting a very reasonable expectation.
Okay.
I think both of us will appreciate that 12-13% on a long term is a very reasonable expectation. We have done significantly better than that, but over a long term, so we just started some years back, so there's a long way to go, but we have as of now done better than what was expected.
Now, you have a job which involves a lot of travel. So let's talk about insurance. How much of insurance do you have? Do you have term plans? How have you strategized on that front?
So initially, when I started, I purely went for the LIC policies, which I'm sure everybody does. And then along the way, like I was explaining earlier, with a MNC bank, we had a fund, advisor who advised some of these products which were, ULIPs, which with insurance and equity, and they were not serving much of any purpose, not for equity or the insurance part, the coverage wasn't good enough. So that was a bad experience.
Okay. And Subir, what's your word of advice to folks who are watching at home about how insurance, while it's not seen as an investment product, maybe to some, but as a sort of a bringer of peace of mind, so that you can actually focus on investing in the right kind of products. What are the do's and don'ts you would advise to folks watching at home when it comes to how they go about approaching insurance as part of their overall financial planning?
So I think building the base when you start your financial plan is very important. And before you dwell into or jump into long-term investments, it's good to cover your bases. And insurance plays a very critical role there. Sadly and unfortunately, the cover that normally people have is inadequate. They grossly underestimate the amount of life cover they need. So to begin with, you need to identify what is your income levels or expenditure levels that you have, and that you can talk to any insurance expert and take a good, healthy term plan. So we are big fans of pure term plan. These days, it's extremely easy to buy one also. So therefore, you should take a good, healthy term plan, which is commensurate to your standard of living. That's very important.
All right. Well, lots of points discussed, but we'll have to take a short break right now. But lots more insights on money management coming up on the Mutual Fund Day Family Financial Plan series. So stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. Let's pick up the conversation where we left off. Subir, a lot of people might have this question, and maybe a few of the investors might have approached you on this question. But what's going to be the impact of GST on mutual fund products? Because there is going to be a rise in expense rate.
Not very significant. The management fee that is being charged a 15% service tax as of now would be charged 18%, and it would be a very, very minimal increase in the overall scheme of things. So investors need not worry on that point at all.
All right, and what are some of the life pro tips you would offer to viewers watching at home when it comes to choosing the right options to create the right tax efficiency for their investment portfolio?
Yeah, so generally what happens is when it comes to tax related investments, so there are two parts to it. One is investing for tax saving, and one is what is the tax implication for your investment. Generally people tend to, especially the younger lot, tend to rush for tax saving instruments at the end of the year. There, I would very clearly say that marry that with your long-term goals and accordingly invest, and don't leave it for the last moment in the financial year. That is one. B, please try and understand that, any investment that you do has a tax characteristic. Please try and keep that in mind. So a lot of folks do fixed deposits and pay a significant amount of tax on it. There are very credible, similar risk instruments available in mutual funds which will have a much, much lower tax implication compared to a fixed deposit and can give you a very similar pre-tax return. So you'll be significantly benefited by choosing those products.
All right, let's shift focus from tax planning to your long-term goals. Now, you have a daughter who's in grade 2, so still some time before she reaches college. So what's your education fund target for her?
I think we discussed this, in the present day, if we have let's say 2 crore corpus, we actually, include the inflation onto that and, run it for those many years, and having that corpus at that time available, for Nitya to use. So we were looking at that, plus the retirement sort of corpus as well. So, or if she doesn't use that corpus, that will be available for some other life event, which can be used.
But you have a 2 crore fund target as a sort of a basic education fund target for your daughter. That's the figure.
That's
right. So now that you have the target, how do you go about structuring your investment to make sure you hit that education fund target? What would you have to say about that?
That's a very good question, because setting targets is only the first part of it. Choosing the right kind of products during the life cycle of this goal is very important. So when we begin with this goal, depending on the tenure left for achieving this goal, we have an asset allocation. So if the tenure is 15 years, we can obviously have a higher equity allocation and lower debt allocation. And then every 4 or 5 years, you gradually decrease the equity exposure so that when the money is needed for education or for any goal as such, it's primarily into debt that ways. So we begin with higher equity and gradually reduce that equity exposure, and then ultimately when we are needing the money, we are mostly into debt.
And Rahul is in a strong position. He has a high-paying job, and of course, and he has that active plan of hitting a target of say 45, 50, where he has front-loaded a lot of his investment when it comes to retirement planning. But what are some of the things he needs to take care of to make sure that the plan he has, that by 45, 50, his retirement fund is done?
So like you said, Rahul is in a position where he can front load those investments. So if he can realign that a little bit over the period of next 7-8 years, he will be in a very good position to do that. The second part of it is the right amount of risk. Sometimes people take too much of risk and sometimes they take little risk. So we call it the risk of not taking any risk.
Has Rahul taken your advice? Has his risk profile matured?
Yes, I think credit to him. I think he has been very, very accepting and open to our suggestions. And gradually, one step at a time, we are getting there. And I'm very hopeful. Like I said, as a family, both Rahul and Preeta, they are very accepting to the fact that they need to do things in order to achieve results and outcomes. And both of them as a family, they are geared towards that.
All right, almost out of time, so I'll throw in the last question to you. It's been close to 2 decades since your investment planning journey began. What are some of the key lessons that you have learned in this journey?
I think the first thing which comes to mind is time. Earlier you start, the better it is. I've seen it for myself. Initially those carefree days, not investing enough. If I had started at that time, it's always good in hindsight. So time is definitely of essence. Earlier you start, and the right products as well. If you have good, solid advice, if you get good structured plan and goals made for you, and that discipline to actually start something at a younger age, it's I think going to be very, very beneficial for anybody.
All right. And Subir, any word of advice for, say, the younger investors who are watching this show? What would you say to them when they're starting out in their investment journey?
If I can say one thing, it is, we have a principle wherein we say that money in itself is of no use. Money at the right time and for the right reason is what makes it meaningful. So whenever you do an investment, try and link it to a particular objective that you want to achieve in life. And I think that would sort out a lot of things when it comes to investing.
All right. On that note, we'll conclude this episode of the Mutual Fund Day Family Financial Plan series. Thank you very much to Rahul and Subir for sharing with us your investment story and, of course, your expert insights on money management. And thank you to our viewers for tuning in. Lots more insights on financial planning coming up. Stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.